Hello, everyone, and welcome to today's webinar, PPP Forgiveness, Can I Really Keep the Money? Before we get started, I would like to go over a few items so you know how to participate in today's event. When you join today's webinar, you selected to join either by phone call or computer audio. If for any reason you would like to change your selection, you can do so by accessing your audio pane in your control panel. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions anytime. We will collect these and address them during the Q&A session at the end of today's presentation. I would now like to introduce Colin Tarbert, President and CEO of the Baltimore Development Corporation.
Great. Thank you all for joining us today. My name is Colin Tarbert. I'm the President and CEO of the Baltimore Development Corporation. We are the city's economic development agency, and I'd like to thank Whiteford Taylor Preston for providing this webinar on the Payroll Protection Program, PPP, as we've all come to know it. The BDC team has been working hard to serve small businesses during this pandemic. All of the business information that we're offering, as well as more information on the PPP program and other programs to benefit your business, can be found at www.baltimoretogether.com. That's a website that BDC set up specifically for the COVID-19 response and recovery. Now I'd like to introduce Kimberly Min of Whiteford Taylor & Preston, who's going to provide some background information and introduce Jordan Halley, our webinar presenter today. Kim?
Hi, good afternoon, everyone. I just want to let you know that it is such a pleasure on behalf of Whiteford Taylor & Preston to be presenting today. We're a full-service law firm that's based in Baltimore City. I personally practice in finance and representing businesses, also in community development and commercial real estate. We asked BDC if there was a way that we could help with the effort in the businesses in Baltimore City. And one of the things that I am able to present is Jordan Halley, a colleague here with me at Whiteford Taylor & Preston, who is our resident PPP expert. And we're looking forward to providing whatever assistance we can to the businesses in Baltimore, because we indeed are in it together.
Thank you, Kimberly, and thank you, Colin. And hi, everyone. This is Jordan Halley. It's a pleasure to be presenting all of this to you today. We're going to have a lot to go through, so I'm going to just jump right in. The presentation outline shows you where we're going to start. We want to make sure we understand some key terms, take a look at what the forms look like for the PPP forgiveness application, and then we'll discuss what costs to include, how the forgiveness reduction calculations work, what the current safe harbor provisions are, and what documentation you'll have to include either with your application for forgiveness or that you'll have to keep on file. Now, let me say from the get-go that this presentation, as I'm sure you all know, the facts, the circumstances, the laws, rules, and regulations are constantly changing with the Paycheck Protection Program. So the forgiveness application that we're basing this off of was released before the Flexibility Act came into effect. So we know that the application is going to change, and we know that's going to change certain aspects of how the calculations will work, and I'll touch on that throughout. So at the top, let's make sure we're all on the same page with some key terms. You'll hear me refer pretty regularly to the Flexibility Act. That was what was signed into law on June 5, 2020, and it fundamentally changed aspects of the Paycheck Protection Program that had really given people a hard time. Kind of the four big ones is that it extended the covered period. As we all knew, there was that 8 weeks from the date you begin, from 8 weeks from the date a borrower received their loan proceeds, that they needed to spend their funds to be eligible for forgiveness. The Paycheck Protection Program Flexibility Act extended that to 24 weeks. We knew at one point that there was a requirement that at least 75% of forgiveness be attributed to payroll costs. The Flexibility Act reduced that to 60%. We learned in the Flexibility Act that Congress was unhappy with a 6-month deferment period and instead instituted a 10-month deferment automatically And then if you apply for forgiveness within those 10 months, then your deferment on payments of interest and principal continue for however long it takes for the SBA to issue a response. And then the final, and this might not apply to many people here, but new borrowers after June 5 have the advantage of a 5-year maturity date. Those were some of the big changes under the Flexibility Act. The covered period I mentioned, another key term, which is the 8-week or under the Flexibility Act, 24-week period beginning on the date that the borrower receives their PPP loan. What we don't know right now is exactly when that election can be made for pre-June 5 borrowers. So anybody that had a PPP loan before June 5 has the option of either staying with the 24-week automatically, or they can elect to use an 8-week covered period. For example, if you had already planned to use all of your PPP funds in 8 weeks and you don't want to wait for 24 weeks, there's going to be an opportunity to make that election, but it's not clear yet when or how that election will be made. And it's also important to note that also as of right now, there are no provisions for an interim date. So if, for example, you used all of your PPP funds by week 12, the way everything is currently written is you still need to wait 24 weeks to calculate your full-time equivalent employees and average wages and then apply for forgiveness. So that's something to keep an eye out on the horizon. As of right now, though, there's no opportunity for an interim covered period. There's the alternative payroll covered period, and this was a concept that was introduced when the instructions for the forgiveness application were released on May 15, where the SBA recognized that for calculating payroll costs, it's a little bit difficult when the covered period starts midway through a pay period. So what they've said is you can start, if you have payroll that's 2 weeks, every 2 weeks or more frequently, you can choose an alternative payroll covered period only for purposes of payroll that are the 8 weeks starting from the first pay period after you receive your funding. Payroll costs, obviously very important because that's going to form the substantial part of your forgiveness eligibility. It's cash compensation, employer portion of payroll taxes and non-cash benefits, and then the non-payroll costs, the interest on mortgage obligations, rent, and utilities. We look at the loan forgiveness forms. As I mentioned, these were released on May 15, 2020, but they will have to be updated due to the Flexibility Act. The loan forgiveness application, assuming it's not going to change too dramatically, but mostly just have updates in percentages and calculations, the application is comprised of 4 specific forms. The front page, the front PPP loan forgiveness calculation form, which will also include certain representations and certifications. Schedule A, which will also be submitted, and that Schedule A, as you'll see in a bit, actually works through the calculations for any reductions from the maximum amount of forgiveness. And then the Schedule A worksheet doesn't get submitted, but it's something you have to keep in hand, and that's what will include your itemized or your detailed list of employees. And from there, you'll be able to do the calculations that happen in Schedule A, and then that got all the way reported at the very top on the calculation form. The last item in here is an optional item, which was the demographic information form. And that obviously is at your leisure whether or not you want to submit it. A note, your lender may or may not digitize these forms. We kind of expect that they will. But even if there's a digital version, it's probably going to be helpful if in advance you print out the hard copy and work through it. Just as you'll see, and if you haven't taken a look at it yet, I encourage you to take a look at the application, just so you can see the way that the calculations work throughout. What you have up on the screen now is the loan forgiveness form, that first item. And throughout, you'll see I've highlighted some items that we know for a fact are going to change as a result of the Flexibility Act. So, for example, the fact that this does not include non-payroll costs in excess of 25%, we now know that it's 40% for non-payroll costs. One other point that is important to note in here is this language right here. If the borrower receives PPP loan in excess of $2 million, The SBA has announced that they will be reviewing all PPP loans in excess of $2 million. So if you have a loan below $2 million, make sure you're not trigger happy filling out this application. You don't want to check this box or else you're guaranteeing a review. The SBA can still review, and they said that they can and may review other loans, but over $2 million, you're guaranteed to get reviewed. One other item, and this is a frequent question that we received even in advance of today, is what happens with the EIDL. If you had an EIDL, an economic injury disaster loan, in advance of applying for the Paycheck Protection Program loan, you could have refinanced the EIDL as part of your PPP, meaning that if you had taken an EIDL out for payroll costs, you would add that amount to the total of your PPP loan, thereby refinancing the EIDL. And in that roundabout way, you end up with forgiveness of the EIDL because it's been included in the PPP. If you've applied for the two separately, so if you first either applied for the PPP and then have subsequently received an EIDL, or if you received an EIDL for working capital, in other words, for ineligible costs or ineligible uses under the PPP, and you weren't able to refinance the EIDL, then the PPP won't affect it. The EIDL remains a loan to your business at a favorable interest rate and with a 30-year maturity period. But unless it was specifically refinanced, then it will continue as a separate loan to the business. Continuing to look through the forms, this is the Schedule A that I mentioned where you would work through, and we're going to get into these in a little bit more detail, but this is the Schedule A where you will work through your reductions to your Paycheck Protection Program forgiveness. And then the Schedule A, and you'll see there are two tables here, and those two tables become important when you're calculating any reductions. The top table will actually impact reductions because that's where you will put employees that have earned less than $100,000 and they're employees, not owners, and they're taken into account. In Table 2 are employees employed by the borrower but who received payroll or wages or compensation over $100,000, and also owners and partners. So let's go a little bit into what the eligible payroll costs for a PPP loan are in terms of what to include for forgiveness. And to kind of think about this conceptually, when you're talking about forgiveness, you're first calculating the maximum potential forgiveness, which are your eligible payroll costs plus your eligible non-payroll costs that you paid and incurred during the covered period. So you find out that maximum potential forgiveness, and then you make any required deductions subject to any safe harbors, concepts that we'll be getting to in a little bit. So payroll costs paid and payroll costs incurred during the covered period are included in the forgiveness calculation, but there's a slight exception to that, which says that if the question of when payroll costs were incurred gave a lot of people heartburn early on. Is it's incurred, it's paid, is this cash basis, is this accrual basis? Well, on May 22nd, the SBA released interim final rules that kind of gave a best of both worlds approach. So any payroll costs actually paid during the covered period or alternative payroll covered period, those are included. So say you took a PPP loan and you received funding June 1, and that started your covered period, but you had payroll due June 2nd for the period even before the covered period started. You get to include that June 2nd payment as a use, and 100% of that is included. On the back end, you actually have to prorate. So if you have payroll that splits the very last week of your covered period, but you pay it during at your regular payroll date outside the covered period, you would just prorate for the portion of the payroll that occurred during your covered period. The final bullet on here is worth keeping in mind is that for each individual employee, the total amount of cash compensation eligible for forgiveness can't exceed that $100,000 annual salary cap, which works out for the 8-week period to 15,385. We have not yet received definitive guidance from the SBA for what happens during the 24-week period. But logically, and what most people are assuming, which is a scary thought in this context, but given that the 8-week cap was 15,385, we all expect that the cap for 24 weeks will be 46,155, just a mathematical triple of the 8-week period. And then also keep in mind that additional amounts above that for salary and wages are still included. So even if an employee was paid $100,000 annualized, so you maxed out that 15,385, you also still include above that payroll taxes, non-cash benefits, 401k contributions. The last thing that we learned in terms of eligible payroll costs from the SBA is that furloughed employees are also included, as well as paying bonuses. So there was some question about what happens if an employee is laid off, but I keep paying them. Do I get to continue to include them? Are those good payroll costs? And the answer is yes, those are good payroll costs. It's to date unclear how those employees are counted for purposes of the full-time equivalency, because they're furloughed, they're not working, but you can continue to pay them. And we're expecting there to be more clarity in the coming months about how furloughed employees are considered for purposes of the FTE calculation. Continuing on our definition and understanding what eligible payroll costs are, up here at the top, note that the alternative payroll covered period only includes payroll costs. You can't use that same pay period you can't use that same covered period for your other non-payroll costs. We mentioned continue to use the employer portion of health insurance, retirement plan contributions, and state and local taxes assessed on the employee compensation. And the last bullet on here was something that, frankly, the SBA took longer to give guidance on than we would have liked. But we eventually learned that for owners and self-employed individuals, the compensation that can be paid to them, and whether it's compensation or if you're a sole proprietor, the amount of draws that you can take out of your PPP loan was specifically capped at $15,385 per owner, or if less, the 8-week equivalent of your 2019 draw. Now, what is going to happen as a result of the 24-week covered period? Again, as I mentioned on the previous slide, we expect that draw will be increased to 46,155, or the 24-week equivalent to the 2019 compensation. But as of today, we haven't received definitive guidance that it's merely 3 times 15,385, but that's certainly what we expect. So those are the payroll costs. The next piece is calculating your eligible non-payroll costs, which are covered mortgage obligations, covered rent obligations, and covered utility payments. In each case, the service or the rent, the lease, the mortgage had to have existed prior to February 15, 2020. And one of the interesting things that we learned when the forgiveness application was released is that covered rent and covered mortgage obligations include real or personal property. So if you lease a copy machine, and that lease was in existence prior to February 15, then that lease is a covered rent obligation, and you can use PPP funds, and the use of those PPP funds will give rise to potential forgiveness. Similar, on the fourth bullet point on this slide, similar to what we were discussing with payroll costs, for non-payroll costs, they also must be either paid during the covered period, in which case there's no proration, or if they were incurred during the covered period and paid on or before the next regular billing date, if that billing date is after the covered period, and you have to prorate. So similar example to before, if your business's April electric bill was paid in May and your funds were received on May 1, the entire April bill is included as an eligible non-payroll costs. on the back end, if the covered period ends, say June 15, and the electric bill for June is actually paid in July on the regular billing date, then only 50% of that bill would be included, right? 50% of the June bill was incurred during the covered period, and so 50% of the bill that was paid in July is an eligible non-payroll cost. Now, early on in the process, SBA said that for purposes of forgiveness, no more than 25% of the amount forgiven could be attributed to non-payroll costs. And for numerous reasons, small businesses were really put out by that because they were shut down and they had 8 weeks to use their PPP loan, and they certainly had rent and mortgage, but not necessarily payroll. So as part of the Flexibility Act, the rule was changed to a 60-40 test. As the act is written, that appears to be a cliff, meaning that the borrower must have spent 60% of their PPP loan in order to be on payroll costs in order to be eligible for forgiveness. Subsequently, an announcement was released by the SBA and Treasury saying that it will not be interpreted as a cliff, that this 60-40 rule will be applied the same as the 75-25 rule, meaning that you don't have to spend at least 60% on payroll, but for purposes of forgiveness, no more than 40% of the forgiven amount can be due to payroll costs. That was only put out as a press release style announcement, but we think future regulations and interim final rules will reflect this non-cliff, but only a comparison question. So up to this point, we discussed the top line, the question of what's the maximum amount of forgiveness to which you are eligible. And now we look to see whether there is any reduction, whether it needs to be reduced. So the two reduction tests are for salary or hourly wage reduction, and the other is a full-time equivalent employees test. After you've applied both of those tests, you would have to consider whether any safe harbor protects you from that decrease. And I will note that the way the Schedule A in the Schedule A and Schedule A worksheet and the forgiveness application are written, they will automatically take you through this process. But for purposes of planning, it's important to understand how they work and whether there's anything you can do now to protect yourself, or at least put yourself on the right path to take advantage of any safe harbors. So the forgiveness reduction calculation starts with any salary or hourly wage reduction. So only employees that have a principal place of residence in the United States and were employed during the covered period or alternative covered period, and who receives compensation at an annualized rate of not more than $100,000 for all pay periods in 2019, or were not employed in 2019, are included for this calculation and for this potential reduction. That means that owner employees are not included, partners are not included, and if you're self-employed, if you're a sole proprietor, then this salary hourly wage reduction will not impact you. So this is only for employees below $100,000 in the U.S. The way that this potential reduction works is it's a comparison for the salary or wage in June from January 1, 2020 to March 31, 2020. And you compare that hourly or salary wage to the wage by employee that employee earned during the covered period. The way that the regulations and instructions are written is that it uses a concept of average annual salary and average hourly wage for both measurement periods, both the comparison and the covered period or alternative payroll covered period. The threshold, it's not automatically decreased. So if you need to reduce wages, 5-10% during the economic downturn, that's not going to penalize you. The threshold is a decrease that exceeds 25%. So if you need to cut wages in order to meet your other demands, as long as you don't cut any wage by more than 25%, then this reduction will not apply to you, and you won't need to, it won't impact you negatively. The way the form works is you'll probably still have to just go through and enter employee information and wage amounts, but you won't actually have a negative impact. So for purposes of salary, you look to see if the annual average salary is less in the January 1 through March 31 measurement period. For hourly wages, the calculation works out a little bit differently, and we'll see that as an example on the following slide. But any resulting reduction to forgiveness is dollar for dollar. So if a dollar for dollar reduction above 25%. There is a safe harbor. So if any reduction in salary or wage is restored by December 31 to the February 15 level, then again, another safe harbor. So in the circumstance where you do need to reduce wages by more than 25%, but you're able to make it back up by the end of the year, then the safe harbor will prevent you from having any additional reduction to the PPP forgiveness amount. So as I said, here is an example just to illustrate how this forgiveness reduction works. So let's assume that Alvin is below 100,000, US-based employee. During the covered period, he was paid a total of $5,000. So that's $5,000 over 8 weeks. That works out to an average annual salary of $32,500. During the first 3 months of the year, January 1 through March 31, 2020, Alvin was paid a total of $12,000, which works out to an annual salary of $48,000. So we need to look at, if he was paid $48,000, a 25% reduction would be $36,000. So that is, as long as Alvin was paid for the covered period an average annual salary over $36,000, we wouldn't have to worry about any forgiveness reduction. But as we saw earlier, Alvin was paid an equivalent salary of $32,500, meaning that his pay was reduced by more than 25%. And the excess reduction, because again, it's only the amount over 25% that we're concerned about, the excess reduction on an annual basis was $3,500. For purposes of calculating how much to reduce the PPP forgiveness, we break that into weeks and then multiply that $3,500 by 8 weeks. So $35,000 per year divided by 52 weeks gets you the per week reduction of $67.31 over the 8 week covered period is $538.46. So the amount of the employer's PPP loan forgiveness that's reduced is equal to $538.46 for Alvin. Say there was multiple other employees, you would have to do the same calculation for all the other employees too to find out the total amount of reduction in forgiveness. Now, how this will work on the 24-week covered period is presumably the same way, except that where 6731 is multiplied by 8 weeks, we would interpret that to mean that now you'd have to multiply it by 24 weeks. So reducing wages can have a pretty significant impact on reduction if it's not able to be made up, based on the rules and regulations right now. Again, I mentioned at the bottom here, if Alvin's wage is restored to the $48,000 annual average salary by December 31, 2020, then there won't be any reduction thanks to the safe harbor. And this comes from pages 7, 8, and 8 of the forgiveness application. You'll see that there is a formula that works through exactly how this reduction would work on an employee by employee basis. This is why at the top I encouraged anybody that even if they have a digitized version of this form from their lender, that they take the time to actually work through the paper form. Right? That can just be a helpful exercise. The next potential reduction, or the other potential reduction, I should say, is the full-time equivalent reduction quotient, they call it. And essentially, it's what percentage decrease in your full-time equivalent employees was there. And that percentage decrease is a equal percentage decrease in forgiveness. So assuming that you had 10 employees and a $100,000 PPP, you didn't cut wages, so we're going to ignore the wage reduction. But over the covered period, your full-time equivalent employees decreased by 30%, decreased from 10 full-time equivalent employees to 7 full-time equivalent employees. Then your forgiveness is equally reduced by 30%. So if you had a $100,000 loan, 30% decrease in FTEs, 30% decrease in loan amount, that means you only are eligible for a $70,000 of forgiveness. The remaining 30% is a loan with the 2-year maturity date and 1% annual interest. And on that, let me also note that the Flexibility Act did say specifically that borrowers and their lenders can renegotiate their existing PPP loan to take advantage of a 5-year maturity date, but that will be something that you would need to discuss with your lender, on a loan-by-loan basis. There's no obligation for a borrower to extend the maturity date from 2 to 5 years, and in fact, we would expect for some borrowers to, or for some lenders to push back because they're not going to want relatively small loans on their books. So, encourage you to ask to see if your borrower is willing to enter into a note with a 5-year maturity date if you think there's a forgiveness issue, but it's not a guarantee and it's not a slam dunk that they'll allow it. So on this slide, this runs down how the full-time equivalency steps to figuring out the forgiveness amount, but we're going to go into those right in the next couple of slides. So the question is, which employees are taken into account? Just like with the wage and hourly reduction, it's again, only employees, principal place of residence in the U.S. that are employed during the covered period or alternative covered period, and who received compensation at an annualized rate of less than $100,000, or who were not employed at any point in 2019. Again, owner employees, partners, self-employed individuals are not included. Neither are independent contractors. And in fact, independent contractors are not included anywhere in any of these calculations and are not eligible to, are not an eligible use of PPP loan proceeds. So early on, there was a question of how independent contractors would be treated under the PPP. And also early on, SBA said that payments to independent contractors are not included in PPP forgiveness or even in eligible use. So the whole exclusion of owner employers, partners, self-employed individuals, you'll see on the Schedule A worksheet, that's why there are the 2 separate tables. So those people who are not included for purposes of the reduction actually go in Table 2. Table 1 are the employees that are included. Now, how do you calculate what exactly is a full-time equivalent employee? Much to the frustration of myself, of our team here at Whiteford, and basically everyone else I spoke to, the SBA never defined for purposes of the PPP what a full-time equivalent employee meant until they released the application, the forgiveness application. And in the forgiveness application, the SBA provided 2 alternative ways of calculating an FTE. The first is to take the average number of hours worked per week by an employee, divide that by 40, and round to the nearest tenth with a maximum FTE value per employee of 1.0. The alternative, and they call it the simplified method, is to assign a 1.0 for all employees with at least 40 hours, average weekly hours, and 0.5, 1/2, to all employees with less than an average weekly hours of 40. Whichever one you decide to use, whether the straightforward method of 40 divided, the total hours divided by 40, or use the simplified method, just make sure you would use that same method throughout the forgiveness application. To determine whether there was any reduction, you compare the FTEs during the covered period with the average number of FTEs per month during one of 2 measuring periods or one of 3 measuring periods for seasonal employers. So either February 15, 2019 to June 30, 2019, January 1, 2020 to February 29, 2020. All borrowers can choose to use one of those reference periods. And if you're a seasonal employer, certain pools and community centers that might only be open for a portion of the year, any consecutive 12-week period between May 1, 2019 and September 15, 2019, you can pick one that provides a good reference and a good comparison as compared to what your FTEs are during the covered period. What's going to make the most sense is to use whichever reference period results in the lowest number of FTEs, so that way if there is any reduction, it's at least minimized. And here at the bottom, and I mentioned this earlier, that under current guidance, how furloughed employees would impact the calculation is unclear. Presumably there will be some explanation and some further guidance, especially because the SBA has said that you can continue to pay those employees furloughed out of PPP funds. So we'll keep an eye out for future guidance there. So let's take a quick look at just calculating the number of FTEs to kind of put into context what we were talking about on the prior slide. So say Simpsons Co. has employees, Marge, who averages 45 hours a week, Lisa averages 40, and Homer averages 16 hours per week. If you're going to use the general method, you have Marge, 45 hours per week divided by 40 is 1.125, and so she's a 1.0 because of that cap. Lisa worked exactly 40 divided by 40 is 1.0, and Homer, who worked 16 hours, 16 divided by 40, 0.4, which means Simpsons Co. had a total average monthly employee FTEs of 2.4. The simplified method says that if you have 40 or more hours, you're a 1.0, so Marge and Lisa are a 1.0, and Homer, who averaged less than 40 hours per week per month, is a 0.5, which gives Simpsons Co. 2.5 FTEs for purposes of these calculations. Whether this makes a difference, the 2.5 and the 2.4, as you see using the two different calculation methods, we haven't seen that to be any significant difference because you have to use the same method throughout. So you can't choose to use one method for purposes of the reference period and another method for purposes of the covered period. You have to use the same method throughout. So, if it turns out that you have a lot of employees that maybe have an equivalent of 0.9, using the simplified method might lower that number a little bit, which for purposes of the comparison, could be to your advantage depending on how close your numbers are. So this is something that you can play with when kind of mapping out what your forgiveness application will look like to see if you can, just by the way the numbers work, either add or reduce any disparity between the covered period and the reference period. But those changes, for the most part, be relatively insignificant. Now, how the reduction works and what a reduction in FTEs will mean when it comes time to forgiveness, we're going to see here on this page. So again, assuming Simpsons Co. received a $10,000 PPP loan, it's not a seasonal employer, and so we look at the two reference periods. The February 15, 2019 reference period, Simpsons Co. had 2.5 FTEs, average monthly FTEs, and in the January 1, 2020 reference period, Simpsons Co. had 2.0 average monthly FTEs. Now, during the covered period, Simpsons Co. had an average of 1.5 FTEs, so there was certainly a reduction. We're going to assume that no safe harbors apply, which we'll get to the safe harbors in a moment. That means that the total forgiveness amount for Simpsons Co. for the PPP loan, the total potential forgiveness, is multiplied by that quotient we looked at before, which is obtained by dividing the average FTEs during the covered period by the average number of FTEs for the chosen reference period. Because the January 1, 2020 reference period, there were slightly fewer FTEs, that's the better reference period to use for purposes of the calculation. And so you see how it works out there at the bottom. If the total forgiveness amount starts with the $10,000 loan amount that we are assuming was fully used for payroll costs, multiplied by that quotient, 1.5 FTEs during the covered period, divided by 2, the FTEs for the reference period. So in other words, it's 75% of 10,000. So the total forgiveness for Simpsons Co. in this case is $7,500. The remaining $2,500 becoming just a loan to the business. And worth noting and keeping in mind is that the PPP loan is an unsecured loan with no guarantee obligation. So if your business ends up still owing money to the SBA, it's only to the business. Nobody would have made any personal guarantees, and there would not have been any collateral taken. So it becomes an unsecured kind of bottom line loan that owners and managers and presidents and officers don't need to worry about having a personal stake. Again, assuming no allegations of potential fraud or impropriety, but as long as you've followed the rules and used the loan as you should have, there shouldn't be any risk of personal liability. So moving on, I've mentioned a few times that there are also safe harbors for the FTE reduction. We knew about this first one. We learned about this, I think, sometime in May, what I'll call the refusal to return to work. So the SBA has said that a borrower can exclude any reduction in FTE headcount that's attributable to an employee under the following requirements. So if an employee was terminated or put on furlough, and the borrower makes a good faith written offer to rehire that employee at the same wage and same hours as during the covered period or alternative covered period, but the employee rejects that offer, and the borrower maintains records documenting the offer and the rejection, and informs state unemployment insurance offices of the rejected employment offer within 30 days, then there's no reduction for that employee. So make sure if that's been the case, and early on that certainly was the case because of the extra $600 of unemployment benefits, there were certainly some employees who decided they didn't want to return to work because they were making more on unemployment. I say making more loosely. But if they refuse to return to work, if you have employees refusing to return to work, you can check off these boxes, make sure you've done a written offer to rehire and inform the state unemployment insurance of a rejected employment offer. That saves you from a potential reduction as a result of those employees or that one employee. The next potential safe harbor was a big deal when we learned about it in the forgiveness application, because it was something that gave employers a lot of concern, which is what happens if I need to fire an employee for cause, or what if my employee resigns, or what if my employee requests to work fewer hours? Then what happens? That was totally out of my control as the business owner. And so the SBA has said, if a reduction has been at the employee's request, and the borrower, the employer, can document the employee's request, then that reduction will not count against the employer for purposes of the of PPP forgiveness. So if you have had any employees that have requested fewer hours, or you've had to terminate an employee for cause, just keep records of the termination or the request for reduction, and that way you have it on hand to make up for any other FTE reductions. There are still more safe harbors for FTE reductions, and these came out of the Flexibility Act, in significant part because when the CARES Act was passed, it was, hopeful that the economy would be back to semi-normal by June 30, which we've certainly seen isn't the case. So the Flexibility Act adds the safe harbor that says a reduction in FTE is not required. A reduction in forgiveness as a result of FTE reduction is not required if the borrower can document in good faith either of these circumstances. Either one, an inability to rehire individuals who are employees of the borrower on February 15, and also an inability to hire similarly qualified employees for those unfilled positions on or before December 31, 2020. So if an individual won't come back to work and you can't find a good alternative, keep records of that attempt, and that gives you this first safe harbor. The second safe harbor is particularly interesting. It is an inability by the business to return to its pre-February 15, 2020 business level due to compliance with established or guidance issued by the Secretary of Health and OSHA during the period beginning on March 1, 2020 and ending on December 31, 2020 related to the maintenance of standards for sanitation, social distancing, and other worker or customer safety requirements. So if as a result of the social distancing and sanitation and cleanliness, and for restaurants, this is very much the case, an inability to return to your pre-February 15 business level, then this safe harbor would also apply to you, and you wouldn't have to take into account a reduction in FTEs because as of December 31, you're still not able to operate at full capacity. Now, for purposes of the calculation, though, one open question, and that's given me some pause personally and a few other clients who I've spoken to about this, other PPP borrowers, is, what happens if you're permitted to return to full business because the social distancing and sanitation standards have been lifted by December 31, 2020, but during the interim, you still had the depressed business and you still did not have full-time equivalent employees, keeping in mind that it's average monthly full-time employees. So what happens if you had to close up for the summer, but then you're back in full swing by the end of the year? That is an open question, and I wish I could tell you for sure that I knew it was going to be resolved favorably. I imagine it will be. But as of right now, that's a question that I've received that we don't yet have an answer to. What happens if, during the summer months, let's say your FTEs are down, which would cover your 24-week extended covered period, but then you're back at full swing by the end of the year. The outcome would seem to be that because you're back to full FTEs, then you're in the safe harbor, but we'll keep an eye out for more instructions from the SBA. And kind of on that note, because we don't know for sure when the election to go from 8 to 24 weeks needs to be made. So a very conservative approach is apply using the 8 weeks if that's more beneficial and because we have more certainty, or what's still an option is to wait the full 24-week covered period before you apply for forgiveness, because as of today, we only know for sure based on the deferment period that you appear to have 10 months from the end of the covered period to apply for forgiveness. So you have 10 months from the end of even the 8-week period to apply for forgiveness, meaning that you can wait and see how the entire 24-week period works out, see what types of regulations are released in the interim, and you can make an informed decision once we have more information about whether you want to elect the earlier 8-week period, again, assuming that you had your loan before the Flexibility Act was passed on June 5. If you received your loan after June 5, you're automatically in a 24-week and you don't get to elect an 8-week. But for those that have the option, this isn't a decision that needs to be made today. This is a decision that can be made in several months' time. Just consider whether there's a way to effectively use your all of your PPP funds before the 8-week, during the 8-week covered period. But if that's not possible, you can use the rest of your PPP funds during the 24-week period, and then basically map out what the alternatives will look like once the 24-week and the 8-week period have fully elapsed. This is the summary. This is a screenshot, right, of the forgiveness application. And you see how the whole calculation is summarized. You, at the top, figure out your total potential forgiveness amount because you're taking your payroll and non-payroll costs. Then you're making any adjustments for your full-time equivalency and for any salary and hourly wage reductions. We check, and I have this highlighted because, as we said earlier, it's now a 60% requirement, and then that gives you your total forgiveness amount. The last bit is exactly what gets submitted and what documents do you need to keep on hand. And the SBA has said specifically that in terms of the forms, the calculation form is submitted and the Schedule A is submitted. The Schedule A being the worksheet for FTE and hourly wage calculations. The borrower demographic information form is an optional form that's up to you. And then for payroll costs, to establish your payroll costs, you'll need to make sure you maintain documentation either from bank account statements or third-party payroll providers documenting the actual cash compensation paid. You'd also keep any tax forms or payroll provider reports showing the overlap with the covered period or alternative payroll covered period, again, to demonstrate the wages paid and the employees on payroll. And then keep also any payment receipts, canceled checks, account statements to demonstrate the contributions to health insurance and retirement plans that were included in forgiveness. That's to document the costs. We also need to document the FTEs. So make sure you keep track of documents that would include payroll tax filings or state quarterly business and individual payroll tax filings, just again, to establish the number of employees and hours worked during all the measuring periods. So you'll want, for example, your payroll tax filings that cover February 15, 2019 through June 30, 2019, and you want your tax filings that cover January 1, 2020 to February 29, 2020, and your tax filings that include for seasonal employers, any of your, whatever your seasonal reference period is, and then also for your covered period. For non-payroll costs, when it comes to your business mortgage and interest payments, you'll need to include any lender amortization schedules as well as evidence of having paid the amounts you claim to have paid. For business rent and lease payments, the SBA has said that they will want the lease agreement. They'll need to see that the agreement was in place before February 15, 2020. And for business utility payments, the invoices for your utilities. It's unclear exactly what they would ask for to establish that the service existed prior to February 15, 2020, but you'll include the evidence of your payments at the very least. Finally, there's certain documentation that the SBA has said you are required to maintain but not submit. That's the Schedule A worksheet, which we saw at the top with the Table 1 and Table 2 for different employees, and then supporting documentation for the individual employees identified on tables 1 and 2 of Schedule A, of the Schedule A worksheet, any employee job offers, refusals, firings for cause, voluntary resignations, or requests to reduce work schedules, and then the Schedule A worksheet for the FTE reduction safe harbor. Finally, the SBA has been very clear that all of these records must be maintained for 6 years. So if you've been keeping good records to date, continue to do so and continue to hold all that in a safe place for 6 years. As mentioned, all loans over $2 million are going to be closely reviewed and audited, and anything less, you might still be, might have a request for documentation from the SBA, including its Office of Inspector General. And it occurs to me, I never mentioned the timing. The timing could be a while for forgiveness. The SBA has said that banks have 60 days to review a forgiveness application and remit it to the SBA. And then the SBA has 90 days to approve or reject a forgiveness application. So it could take a while, which is all the more reason to make sure you keep your records in a safe place. So that brings us through the whole PPP forgiveness process. I have had a few questions come in since we've started, and I'm not going to be able to get to all of these. So the plan is to put together an FAQ or a Q&A and make that available to you. But for the moment, I'm going to run through a couple in the few minutes we have left. One of the questions is whether the 60% rule still applies within the 8 weeks. The answer is yes. The Flexibility Act totally superseded the 75-25 rule. So it's now a 60% rule for all instances. The time frame to apply for forgiveness, whether it's 10 months from the end of the covered period, and the answer is, as of right now, yes. It's 10 months from the end of the covered period, which means either 10 months from the end of 8 weeks or 10 months from the end of 24 weeks. Again, how and when an election to choose 8 or 24 weeks will occur, we still don't know, and that could really impact us, but we don't know that yet, and we're going to keep an eye out for that rather important development. Another question, and I think we addressed this also earlier, is what happens if you try to reopen but then have to go out of business? If you have to go out of business and you apply for forgiveness, then there's no real issue there. But if you have to go out of business because you have to go out of business and you don't get full forgiveness, then it's a debt of the business, assuming you're operating through a business entity, and there's no personal liability. It'll be a bad debt to the government. It'll be a bad debt to the bank that's guaranteed by the SBA, but you won't have any personal liability. It'll just be an unsatisfied creditor at the time you have to close your business. I'm getting some messages that I'm out of time, but I'm going to save these questions and we'll put together some FAQs and post them through the website. I don't know, Colin or Kimberly, if you have anything else to add at this point, or if we're wrapping this up.
So this is Kimberly. I think as we all can see, this is very complicated, and as Jordan mentioned, we'll be posting this as a resource for all of you and putting together some answers to those questions. And if you come up with a question after this time, please feel free to also send that along, and we'll include that.
This is Colin Tarbert. I just wanted to thank Kim and Jordan again for your time and expertise. And of course, we'll work with Whiteford Taylor to provide this at BaltimoreTogether.com. And again, really appreciate everyone for tuning in, and appreciate the Whiteford Taylor Preston team for offering the help and doing such a thorough, impressive job.
Thank you very much.
Awesome. Thank you, Jordan, Kimberly, and Colin, and thank you everyone for attending today's webinar. We apologize if we didn't get to your question due to the time constraints today, so please be on the lookout for that FAQ document when it's released. You will receive a follow-up email within 24 to 48 hours with the link to view a recording of today's webinar, a copy of the slide deck, and contact information for the presenters. Thank you. On behalf of Whiteford, Taylor, and Preston and the BDC, thank you for joining us and have a great rest of your day.